Good morning, good afternoon. My name is Michael Belfer. I'm a partner with Anchin, Block and Anchin in the Service Practice Group. Today's presentation is called Moving and Shaking, How Relocation Can Affect Your SALT Responsibilities. So the topic is pretty relevant for today. Before I introduce my partner, Alan Goldenberg, I want to give you a little bit of a discussion how this came about. We are receiving a tremendous number of inquiries from clients and others with regard to state and local tax responsibilities. So we broke the webinar into three areas. We're going to talk a little bit about personal income tax. We'll talk about business taxes. And the last topic is a new topic in the SALT world with the pass-through entity tax that many of you have probably been hearing about with regard to New York State establishing a pass-through entity tax law. So just a little bit of housekeeping. You can email questions in the chat box. They are being monitored, but we thought it would be best to have Alan roll through the presentation and then address the questions at the end, but you can address the questions. You can send them in a chat box and we'll monitor them. If we do not get to your questions, we will surely get to them after the webinar. You'll get a response from someone on our team. The presentation is being recorded, so again, we will disseminate that as well as the slides. So without further ado, I wanted to introduce everyone to Alan Goldenberg, partner in charge of Anchin's SALT tax group, state and local tax group, who will walk us through the topics. Alan?
Thanks, Mike. I appreciate it. And thank everybody for joining us today. As Mike said, this is really in response to many questions we received from you. I know Mike and I have had many conversations with a number of you who are tuning in today, as well as others who have many questions with regard to state and local tax responsibilities, you know, in light of the current environment, both remote work as well as the new tax rates. So let's just run over the agenda quickly. As Mike mentioned, we're going to touch a little bit upon personal income tax, residency, a lot of people moving to various states, how that plays out in terms of one's tax responsibilities, as well as opportunities to potentially reduce taxes by moving to other jurisdictions. We'll then touch upon business taxes, how states tax businesses, but also, many people are interested in selling businesses or relocating their businesses in light of both, remote work, as well as the increase in tax rates. And finally, we'll touch upon the pass-through entity tax regime and so potential opportunities for savings, certainly in the high taxing jurisdictions. So to jump right in terms of personal taxes, this is really the big issue to kind of set the stage. Focusing in on New York as an example, the pandemic spread a lot of fear within the various state taxing jurisdictions that revenues from taxes would be decreased. And as a result, to kind of reinforce their coffers, New York, as an example, in their most recent budget, passed quite a significant tax increase. New Jersey did it last year. New York has been getting a lot of play in the news because New York now has taken the lovely mantle of being the highest taxing jurisdiction in the country. And you can see here from the slides, the New York has now instituted a higher tax rate of 9.6% for many taxpayers. That's an increase from the prior 8.82% tax rate. And in addition, New York has instituted a temporary 2 tax brackets for those, making quite significant levels of income. You can see here, the $5 to $25 million being subjected to a 10.3% tax, and those making over $25 million a 10.9% tax. It's important to note that with these new tax rates, the state has instituted a tax cliff, whereby if one's income exceeds the bracket by $50,000, their entire income then becomes subject to these new high tax rates. I would also point out the fact that when I list temporary on the slide here, we should put that in quotations. New York, during the 2007, 2008 recession, increased its tax rates to the 8.82% tax that was previously the high watermark for the state. That was supposed to be temporary as well. However, the state has actually extended that 4 times. And once money starts flowing in because of those no high tax rates, it's very difficult for the state to roll those back. So it's really interesting to see down the road what New York is going to do, with these new temporary rates. And just to kind of finish off here, New York City, as I said, is now the highest taxing jurisdiction in the country, overtaking California. For those residents, the tax rate now could be over 14.8%. Now, Governor Cuomo, when he did pass this new tax bill, stated that that it was really predicated on the fact that the federal government would reinstitute the SALT deduction. The Tax Act under President Trump limited the state and local tax deduction to $10,000. It was a temporary limitation, but to kind of offset some of the New York state tax increases, Governor Cuomo was adamant that the federal government reinstitute the SALT deduction. As of now, it does not seem like there has been much buy-in from the Biden administration. The latest infrastructure bill that he put forth did not include a repeal, and that's mainly due to the fact that the vast majority of those who would benefit from the SALT deduction are those earning over $1 million. There are certain districts within New York and California that benefits for certain taxpayers can be well over $100,000. That does not play in well to the Biden administration, their plan, what they've been discussing about increasing tax rates to those making over $400,000. And as a result of that, there's a lot of uncertainty whether the SALT deduction will be brought back or if there'll be an increase in that or potentially raising the usage of that going forward. So with that in mind, many taxpayers are really considering moving out of New York. Some have started that process already. And this is what really has set the stage to the further discussion within this presentation. So let's jump into residency a little bit and let's talk about some of the factors and how resident states tax their residents' taxpayers. Ultimately, states have the ability to tax their residents on everything that they earn, and that's obviously a big amount for many taxpayers. A state that a non-resident state can only tax income that's sourced to that state. So for those individuals living in high tax states, New York, New Jersey, California, there really is a lot of tax liability potentially hanging by living in those states. So how do the states determine one to be a resident of that state? There are really 2 tests. And those tests, primarily fall into 2 baskets. The first one being the domicile test, and the second one being the statutory residency test. The second one is always the easier test, right? That's the one we hear about all the time on the golf course. That's when we all, talk about with our friends, and that's the 183-day test. I'm in a particular state. I've been there for 183 days, or I've stayed out of this state for 183 days. And that's the one that we often refer to. That is fairly easy to comprehend. The more difficult test, and the one that really needs to be focused in on, and the one that we advise many taxpayers on, is the domicile test. And that really looks to the intention of a taxpayer. Where is their primary home? What's in their mind? What have they done to support the fact that they've now moved from, say, New York to Florida, which is what we're seeing quite a bit of now. And this is really where the trigger is, and this is the focus of residency determinations. If one were to dispose of their historic home, if one were to rent out their historic home, then this analysis becomes a much easier process because they don't have a place to return to. If I lived in New York and I sold my house in New York and moved to Idaho, and I bought a home in Idaho and lived there, New York doesn't have that tie, can't connect me to that state. In the same way, if I retain the home in New York, then it becomes a much bigger analysis from a state residency perspective. So let's go through some of the domicile tests in determining one's residency. These are some of the major ones that you will see with the various states. New York has a very robust guidance that's out there. They have very good, very taxpayer-friendly, easy to read, to understand guidance that they've issued. And many states have piggybacked on a lot of the information that's out there. And really what these 5 primary factors do is help build a case. They help explain a narrative. What did the taxpayer do, and using support through these various items, the home, business, time spent, items near and dear. And we'll get into some of these next, but I think in this environment, and one of the things we are seeing most in our practice is a real focus on the business factor. And the reason being is that many people are picking up and leaving the high taxing jurisdictions to a no tax state, to Florida, to Texas, yet their businesses still remain in the historic state. And what the taxing states often do is try to pull residents and taxpayers back into those states by saying you still have an active business connection with the historic state. And that's really the issue. And I think that's one of the big items that need to overcome in the domicile analysis, which is why we will focus in on that on the second part of our seminar about moving as well as selling businesses. In terms of some of the other domicile factors, the home is a big one. They want to see that you've kind of maintained your lifestyle. You haven't moved from a 5-bedroom historic home that you raised your family in, and your kids all grew up in, and you moved to a 1-bedroom studio, in some rural Florida. You really want to see that you're actively moving and stable. And there's some comparison there in terms of lifestyle. The other one is time. How much time are you spending in a state? We usually like to see the majority of one's year spent in their primary residence. And sometimes you can support that by looking at, holidays and family gatherings. Where are you for those important, landmark days of the year? Fourth item is items near and dear. And we often advise our clients to move items. Send clothing, send your heirlooms or collectibles to your new state of residence. It is very important to document the fact that you've moved. Auditors oftentimes have a hard understanding that people can maintain 2 homes at the same time, can have 2 sets of clothes and not have to move furniture back and forth. So sometimes effectuating something by at least shipping some items and making sure you maintain those receipts really will go a long way in showing that there was a demonstrative effort to change one's domicile. And finally, the family factor. This is also a big one now with so many people living in vacation homes. The family unit is typically together in one place. And where the kids going to school, that's always a big one. Are they Zooming? Do you plan on returning back to your school in Manhattan? Or is this something that they're going to go to school now in Florida? So these are kind of the big factors. You hear about some of the other factors all the time. I changed my driver's license. I changed my will. Those are good factors too, and they help. But in general, these are the primary factors, and these are the ones that the states will look at in determining a domicile.
One point on the domicile issue is that people are doing things now in connection with some of these changes in domicile, but you need to remember that in the case of New York City or New York State or a higher taxing jurisdiction, they are going to have the benefit of a look back to see, did you just move to defer tax on a high year of income, a sale of a business, and then after that transaction or that year is done, you move back to your previous residence, where audits, and we have heard from New York City and New York State that audits are going to be the state and city are going to be extremely aggressive, and they will have the benefit of a look back.
Absolutely. This is something we're seeing already. We're already seeing clients get notices about their changes of residency, and we're expecting a lot more, which is great for me because it's job security, but something that we have to plan for now and work with you on that to make sure we have the right documentation in place, to really push back and to show that there was a change. So what are some of these takeaways? Understand, taxpayer has the burden of proof. So you really need clear and convincing evidence here to show that there was a change of domicile. The best way to do that is to document, document, document. Have that contemporaneous. We don't want the situation to be happenstance. We'll turn around in 3 years and say, oh yeah, I did change my state of residence. We really want to make sure that we've implemented a plan, and started, documenting that now. Um, Lifestyle is important. Is there a change in lifestyle? Did something occur? So many people retired during COVID. So maybe that will fit the bill. Maybe that's enough to turn around and say, I moved, COVID hit, I can work remotely, or I've decided to give up my practice, and that was the trigger point. And I think finally here, permanency is paramount, right? The more we can show, as Mike alluded to, the look back in a few years, New York can kind of turn around and come back after you. If you can really show that you've left and you're not returning, I think that's a big feather in your cap there. So let's just turn quickly to the statutory residency test again. This is much easier one. And oftentimes it's the domicile test that's the one that really takes the focus of an audit. But nevertheless, it's important to make sure that we don't trip statutory residency. And with statutory residency, there's really two elements to that. One is the 183-day test. Where are you? What is your presence throughout the course of a year? And two, do you have the place of abode? Do you have the historic home to go back to? Is it available to you or not? And that's sort of the make or break there when it comes to statutory residency. I will tell you from experience, it is very easy to track one's location on a day-by-day basis. You look at credit cards. I can't tell you easy pass records, office key card scans. We've done all this. And New York now is becoming very aggressive with cell phone records. They are able to collect records from the cell phone companies to see where the tower pings are to determine one's location. In addition to this, there are great apps out there that you can download on your cell phone that will give you all sorts of data, and really Big Brother is watching. They will see where you are, and in anticipation of an audit, it might be very helpful to consider that as well.
And just remember that New York City and New York State have separate calculations for this. So, it's not if you are a New York State resident, you're automatically in New York City. There's the same criteria would for each jurisdiction.
So let's just talk about some key takeaways here when it comes to change of residency and domicile. First and foremost, you have to leave your historic state and land in your new state, right? You can't be a nomad. I've had many people reach out to us and say, I'm leaving New York, but I'm going to spend 6 months in Montana, and then I'm going to go to Utah, and then I'm going to go here and there. That's not, you haven't landed anywhere. You haven't settled. And you really need to show that you've settled and you've reestablished your domicile somewhere else. You mentioned it before, the burden of proof is clear and convincing evidence. You are guilty until proven innocent. Your historic domicile stays until you can prove that you've changed that domicile. And I think coupled with all of this, the 2020 hindsight, the fact is that states have 3 years, some of them 4 years, and California has 6 years to come back and to audit an individual for a change of residency. So they're coming. It's significant dollars that are being lost in terms of tax revenue, and whether that's going to come this year or next year, or in 3 years from now, people need to be ready that to really build their files in anticipation of these audits. They're coming. Mike and I are dealing with audits right now and nexus questionnaires of individuals who are getting W-2s of $100,000. So they're auditing people across the board, really regardless of their level of income. What are some of the common audit issues that we often see? And this is really regardless of raising rates and remote work. I can't say how many people come to us and say, hey, I've moved as of January 1st. I've never seen a move truck show up to somebody's house on January 1st. It doesn't happen. It looks odd. You need to establish a real date, draw that line in the sand, as to when you move. If you're going to move, make sure you do it, the full gambit. Change all your mailing address, on your tax documents. Give up any tax benefits you have. You have Manhattan parking exemption. If you retain that, not a good factor when New York City comes back and asks you to prove that you changed your domicile, and you claim that you've been living in Florida for the last 2 years, yet you've been getting this tax break. And the residency questionnaires, they're coming. We're seeing them a lot lately. It is best to reach out to us to really work through those questionnaires. Do not simply respond. New York State, New York City, California, they really delve into these answers. And if there's any low-hanging fruit, or anything questionable, they really dig into that, certainly causing a lot of suffering for taxpayers to try to prove their change of residence. So let's turn our attention now to non-residents. Just because you leave a state doesn't mean that they don't have the ability anymore to tax you. That's a common misconception. Just because you move out of New York doesn't mean that New York can't tax you. There is a lot of income that New York can still tax. Again, business and profession. Your business is still located in New York. It's earning New York source income. You're taxed in New York on that income. Many people are receiving pension plans or installment payments that occurred when they were originally New York residents. Those continue to be under New York jurisdiction. You sell your home, your real estate, those are all sourced to the state of where they are located in. Understand also that with these non-resident returns that you file, a copy of your federal return is attached. So those non-resident states have all of your income information. They will analyze that. And if there's potential for a windfall down the road, if somebody moved and sold their business, and they're filing a non-resident return in their historic state and they see this major windfall, that is an audit trigger for residency. And one final note on this topic is this convenience of employer rule. And we've gotten a lot of questions on this lately by many people in this remote work environment. New York has this really unfortunate rule that states if one is assigned to a New York office but works remotely for their own benefit. So if you're live in New Jersey and you work in New York, or if you live in New York now and say you move down to Florida, but you're still assigned to that New York office, you're a New York employee in the eyes of your business, well, then New York considers you to be a New York employee and will subject you to New York withholdings on that income. So where we are seeing this, as I said, is really many people who have been sheltering in place. They've been working remotely for the last year plus, and New York has been adamant that COVID is not an exemption to the convenience rule. So as a result, many people's wage withholdings continue to be sourced to New York, and obviously with the higher rates, that could be problematic for many. So what are some of the workarounds for that? The first option that we often recommend is to establish an office in the new state. Many people move into Florida, many people move into Texas, open a WeWork office, open a Regis office in that state, assign those employees to that office. Well, now they're no longer New York employees. They're not working remotely for their own convenience. Rather, they're assigned to that new business location, and that will avoid them having to be subjected to New York tax. Second option is to establish a bona fide home office. New York has issued guidance really about more than a decade ago about what it means to establish a bona fide home office. There is a list of factors that one has to go through to substantiate the fact that their home office is in fact a place of business. And if so, if that could be established, then there is potential to avoid the convenience rule. The final option here is this telecommuting option. And this is new, it's still evolving, and it's really come to light because of the remote work and the pandemic. This may be the hardest one to prove. But many people have new work arrangements where they no longer have to come into New York State, New York City. They don't have an office anymore to commute into. And perhaps there have been some cases going on and lingering out there about, if I never come back into New York and I'm not really assigned to the New York office, can I be treated as, an out-of-state employee and not subject to the convenience rule? Again, still evolving.
So Alan, just to point out the difference where there's several questions coming through on it, where you have staff that was working in New York has permanently moved to a more favorable tax state. Texas, Maryland is one of the questions. That person is still assigned to the New York office unless the company establishes an office there. Different from then if you hire somebody new who is living in Maryland from the onset, then one, it creates nexus issues, which is a whole nother, we'll get to that probably in the business part of it, but that is different from someone who was originally assigned to an office that has moved to a different state if the company does not open up an office and reassign those employees to that office.
Yeah, it's a great point. It's really different tests, right? You hire somebody who is never assigned to a New York office, we don't have to worry as much about the convenience rule. It's much more difficult to overcome when you've been withholding for an employee who's been, in the New York office for the last 12 years, and now all of a sudden, it has started to work, from their home in New Jersey. And that's really where this will, trigger and come into play. Okay. So let's switch gears and let's move into the business aspect here. And as we said, one of the things about residency and non-residency is that where your business is really determines where that business income gets taxed. It's not so much where you are a resident of per se, it's where that income is earned. And that's why it's very important to kind of take into account where that business income is coming from, in addition to where it is that you live. So we'll jump into this. So just to set the stage in terms of selling and moving a business. So let's talk about, for selling, just a kind of a core concept is this idea of apportionment. This is the concept of how states divvy up income that's earned for businesses operating in multiple jurisdictions. By and large, there's sort of this formulaic approach that comes from old common law. It's been around for more than a century here. Various states have various factors, but by and large, we either look at a 3-factor formula or a 1-factor formula. Many states moving to the 1-factor formula, which is we look at sales. Where are your sales occurring? If I sell widgets into Utah, those sales are sourced to Utah. I look at the volume of sales I have to Utah, and that's where I get taxed on. Other states continue this older methodology of a 3-factor formula, which not only includes sales, but also includes property as well as payroll. We look at what is occurring in that state overall with these 3 factors. We come up with a ratio. That ratio is then applied to the business's net income, and that determines what the tax base is for that state. Really, how a state uses its apportionment factors and applies its apportionment factors really determines or dictates how a sale of a business will be taxed. So the structure of the the sale really has a lot to do with it. If we look at an asset sale when we're selling the assets of a business, this is where the factors come in. Where is the real property located? Where is the inventory located? Where is that being used? Where are we shipping that? Those states will lay claim to sourcing those the sales of those items to that state. So if you have a state that operates in 20 jurisdictions, they have inventory in 15, they have payroll in those 20 states, you're going to have a lot of sourcing going on to the various jurisdictions. Just because the owner of the business, let's say, lives in Florida or lives in Texas, a non-taxing state, these other states will be able to lay claim to the sales proceeds. Conversely, if one were to sell their partnership interest, that is typically deemed to be an intangible item. That gets sourced to one state of residence. And that's where the potential for significant tax savings is. Right? So many of our clients considering moving from New York to Florida, and they do want to end up selling their business. If they can sell their business interest, if they can sell their partnership interest, that would then get sourced to Florida. It doesn't matter per se where the business is operating. And that obviously can create really, really big state tax savings. There are some exemptions out there. I kind of threw one in there with regard to New York. If there's underlying real estate in that partnership, that could get thrown back to New York as well. But that's really the potential. Similarly, on the corporate side, when it comes to stock sales, there's benefit there too. Selling a stock as an intangible item. It's sourced to one state of residence. There is a little bit of a nuance there with regard to S corporations and 338H10 elections. It's a federal election that allows a business that is an S corp that sells its stock to be treated as an asset purchase. And the reasons for that, a little bit beyond the scope here, basis reasons and liability reasons, but many states will treat that as an asset sale. So you won't get that same tax benefit in terms of selling an intangible. Now let's talk a little bit about moving. And we'll switch gears because they kind of go hand in hand, and this relates to sourcing of service receipts, and this also impacts how an entity is taxed. States primarily look at two approaches. One is a market-based sourcing. We look at where is the benefit of our service being received versus a cost or performance-based approach. Whereas where's the work being done, right? On a market-based sourcing, it doesn't matter where your employees are. It doesn't matter, where your offices are. It matters only where the location of your customer. Cost of performance is where there is potential in moving a business to save taxes. Right? If you're in a high taxing state, such as a New York for partnerships, as an example, which would tax all of the cost of performance being done. If you were to move those individual employees to another jurisdiction that may not be a cost of performance state, or that may be a lower taxing jurisdiction, you can now source sales out of New York and therefore reduce your New York tax exposure. And this is happening now. It almost happened by default a little bit in the remote work environment. We've seen this quite a bit on the New York City side with regard to UBT taxes. And now businesses, I think, are seeing the potential for this. Now with remote work, we can hire people all over the country. And for cost of performance states, that could be a real tax savings. So how does that play out? Again, apportionment and sourcing, this is really the crux of state tax as to where a business has its tax income going and where it can save taxes. I think there's less planning on the C Corp side. I don't think there's as much benefit there. Reason being is that in general, states are market-based states and single factor states. So what that means again is if I have a C Corp and they're selling services or they're selling product into a particular jurisdiction, most states are just going to take those sales into the state and tax them. So shifting your operations is not going to change anything, because you're only taxing on where the benefit, the end product, winds up. So as a result of that, where the individual shareholders of the business are located isn't as big a tax savings. And with regard to C corporations, we also have this potential of nowhere income, right? Which basically means is that if in a particular jurisdiction you have sales or the C corporation has sales into that jurisdiction, and they don't have nexus there, the C Corp is not subject to tax there. So they have their own built-in, tax savings potential there. But beware, if you move the C Corp now, you open operations in that jurisdiction, in that nowhere income jurisdiction. Now you have nexus, and now the C Corp becomes taxed. Where I think the bigger savings potential is with regard to partnerships, because ultimately that's the income there flows through to the shareholders, to the partners of the entity, and depending on where they're located, as well as where the partnership itself is operating, cost of performance state, there could be some significant tax savings there. So if the owners or partners of a partnership move to Florida. If you were to move, let's say, your business to, say, a market-based state and export your product or your services, that could really transform your income to no longer being taxed in a high tax state or into various states, and rather it will all flow back to the partners living in the no taxing jurisdiction. So what are some of the compliance aspects of moving a business? Very important to close out your tax accounts, file final income tax returns, final sales tax returns. Need to draw the line in the sand. This puts the state on notice, and it gets the statute of limitations running. If a state wants to come back to audit the business or to audit the members and partners of the business for residency, we want to make sure we've established that date. So this way, going forward, we've kind of established, and there's a limit to how much exposure the state can go after. In addition to that, you need to withdraw the entity. Many states, New Jersey as an example, if you are registered to do business in New Jersey, you have nexus with New Jersey. There's a filing requirement with New Jersey. So understand that you want to withdraw and remove your business from the state. What are some other aspects about the new state? I can't tell you how many people forget to register with the Secretary of State. Can't operate in a state without registering with the Secretary of State. There are big fines and penalties that can go along with that. You want to make sure that you've registered for payroll and your unemployment insurance. That oftentimes will be done through your payroll company. Some jurisdictions have licensing fees and other items that are out there. You want to make sure you're kind of up and up with all those. And finally, we've come across this a few times more recently with businesses moving, and that is sales and use tax exposure. There are some states that if you're moving your business property from one state to a new state, they may tax your items. There are sometimes exemptions out there where it comes into play is if the new state has a higher taxing rate than the state that you're moving from. That differential on the office equipment, that may be maybe some tax exposure with regard to that. Okay. Finally, some other considerations that are out there, and these are some things that you, as business professionals, you running the business, really need to take into consideration. We're kind of moving away from the tax requirements and moving into some of the day-to-day operations. Moving employees, will they move? We, for example, have been dealing with a financial services company in New York City for the last 3 months that is opening an office in Florida. In the very beginning, half of the employees were going to move to Florida. Office is opening next month, and as of right now, 1 employee is moving. So understand that leaves potential, right, to still cost of performance. The employees are still remaining in New York. The income they generate is still New York income. So even though we're opening up Florida office, we still have that, New York tax exposure. Many businesses require certain local talent. You have to understand, is there an opportunity to hire new people? What are your current clients going to think about you opening? Are they concerned about FaceTime? Will you still be able to interact with them or not? What's your commuting going to be like? Losing that face-to-face, meeting potential. And what are some of the new aspects about moving? You opening a new office, you need new bankers, new landlords. What happens with your warehousing? These are all hurdles that need to be overcome and really look through to make sure that there is real opportunity to consider moving a business. Okay. All right. So with that, we'll move into the final part of the presentation, and that has to do with pass-through entity taxes. Even if one doesn't move, even if a business stays put and everything continues the way it is, there are potential opportunities out there for tax savings. And how this came about really is in response to the SALT cap. So very basic pass-through entities, typically they're partnerships, LLCs. the income flows from the business to the shareholders, to the partners. And the ultimate goal with that is to avoid the double taxation that applies for corporations. Corporations pay a corporate tax and then dividend out their income to shareholders, and the shareholders then pay personal tax on the dividend income, effectively creating a double tax on the same dollars. So about 95% or so of businesses in the United States are pass-through entities, meaning the shareholders and partners are taxed on the income directly. So pre-TCJA, kind of mentioned this at the outset, individuals were able to deduct on their federal tax returns all their state and local taxes that they paid to the various jurisdictions. 2017, Trump Tax Act limited the SALT deduction to $10,000. It was perceived to be an assault on blue states, primarily the high-income blue states. And so in response to that, states started developing ideas, concepts, workarounds of this SALT deduction cap to at least provide some benefit to their residents and alleviate some of the burden of the loss deduction. So what states began to do is create these pass-through entity tax regimes. And effectively how these regimes work is that the pass-through entity is almost no longer treated as a pass-through. Rather, they are taxed in the same way that a corporation would be taxed. They're taxed at the entity level. The tax that is paid by the entity is then passed through or credited to the shareholder or partner of the business, such that it will offset their state income tax. And kind of coupled with that, there would be a state tax deduction, a federal tax deduction, excuse me, for the state taxes that are paid by the entity, because these are deemed to be ordinary and necessary business expenses. Now, in 2020, 7 states jumped on that bandwagon. They jumped in on the deep end. Connecticut was the first one. Theirs dates back to 2018. And there were a number of variations as to how these regimes were implemented. Some of them were primarily elective. Connecticut is still mandatory, and kind of how it plays out on the individual tax return varied. Some states gave a full credit for the PTE taxes that were paid by the entity. Some, like Connecticut, still only gives a partial credit to the partners, and others exclude the income entirely on the individual shareholder's state income tax return. This has kind of really picked up steam. You can see here that the number of states have jumped on the bandwagon. There are many more that are proposing these regulations. Literally, it's updating by the day. And of course, we know that New York and New Jersey have recently implemented their own PTE tax regimes. So as I said before, there was a lot of kind of a spearheading of some sort of SALT cap workaround that was going on out there. But we really weren't sure at the time, when those 7 states came out with their initial passage of the PTE taxes, whether this would hold up in terms of the federal deduction. And in early November 2020, the IRS did release guidance, basically blessing these tax regimes and saying, yes, if a pass-through entity pays an entity level tax, whether that's an elective tax or whether it is a mandatory tax, whether the owners receive a deduction or a credit for that tax, doesn't matter. It is okay to deduct those taxes paid on the federal return. So that turned out to be a big boom for pass-through entity taxes to at least offset some of the higher rates and the loss of the SALT deduction. So in 2000, New Jersey implemented their own pass-through entity tax regime. They called it the BAIT, the Business Alternative Income Tax. But like we've had conversations with many of you, there were some drawbacks to New Jersey's BAIT. First and foremost, for non-resident partners that elected into this regime, the partnership still had to withhold taxes on the non-resident partners. So effectively, that created a double tax regime. A business paid the bait tax and in addition withheld taxes on non-resident partners. Yes, the partner will eventually get a refund for the overpayment or for the double payment of tax, but from a cash flow perspective, it was rather onerous and is rather onerous on many fronts. The second question that we had a lot of going back and forth on is with regard to how other states will perceive these pass-through entity tax regimes, in particular New York. You know, many states, resident states, will grant credits to their resident taxpayers for taxes paid to another state. Will New York, or did New York allow such a credit for taxes paid by a pass-through entity? That was a big question that was out there. There was some debate as in terms of the regulations and the statutes that were out there, how the forms played out. It appeared from us that for partnerships, New York would agree and allow partnerships to or partners of partnerships to claim a credit for the taxes that were paid under the bait, whereas S corporations, it's a little bit more problematic. Lastly, let's just talk quickly about New York's PTE. This is brand new. This came out with the raising of the rates under the most recent budget. It's gotten a lot of play recently, and Governor Cuomo has kind of made this out to be, again, to dampen some of the blow from the raised rates. It is new for 2020. It is elective. This year, because it is the first year, the election does not have to be made until October 15th. However, New York has issued guidance that taxpayers can still need to continue making their 2021 estimates because simply there's no way right now for the state to accept payment for those that do want to elect into the pass-through entity tax regime. The rates fall in line with the new raised rates. And New York is giving partners and shareholders 100% credit for taxes that are paid by the pass-through entity. What the statute also did was formalize the credit. The issue that we had previously that I mentioned with regard to New Jersey with the S corporation versus partnerships, New York has clarified that and said if taxes are paid by a pass-through entity under a similar regime, so a similar type of tax regime from a pass-through entity tax type regime to another state, those are fully creditable to New York residents. So what does this mean? What is the pass-through entity tax regimes now? What's the fallout of that? Well, we've essentially done away with the concept of a pass-through entity because they're now paying tax, at least at the state level. The first point here is important. How do states that don't have a pass-through entity tax yet, how will they treat a partner's credit in a particular state? If the state's not going to give a credit, essentially what we've done is we've traded a federal deduction for an increased state tax. The partner will now be taxed in their resident state on all that income. So it's certainly problematic. What happens in another state like Connecticut, where they're only issuing a partial, credit. Effectively, that's increasing the state tax rate. So understand the taxes are going to go up. Potentially, there's opportunities there that the states are going to collect a lot more tax than what's really owed. That the PTE taxes are paid on the income that's earned by the entity, but if the individual partners, themselves are on a lower tax rate, they would be due refunds. So, from a cash flow perspective, there's really going to be an outlaying of cash. These are all, items that need to be considered and to be understood prior to electing in. And of course, we don't know what's going to happen with the SALT cap. Is it going to be included in the infrastructure plan under the current Biden administration? It's temporary, the cap. So what happens when the cap is eliminated? Will it be eliminated? Will it be extended? And how does all that play out? These are questions, for down the road, but there certainly is potential opportunity for many to take advantage of the PTE tax regimes, circumvent some of the higher tax rates and the loss of the SALT deduction.
Now, in these pass-through entity elections are usually an annual election. Just wanted to confirm. As opposed to just making it once and you're within the regime, it's an election that has to be made each year.
So I think with that, Mike, we can open it up to questions.
Yep, a couple questions came, going back to the New York State income tax rates. What is the effective date that those rates go into play?
It started in 2021, so it started January 1st.
Okay. Someone had a question with regard to the constitutionality of the New York convenience rule. So the comment I made is that the New York convenience rule is not something that's new. It has been around for many, many years. I don't know if it's been challenged at upper courts at all.
So it's a great question, and it's actually received a lot of play, not necessarily in New York, but Massachusetts. During the COVID, shelter-in-place rules that were out there, Massachusetts posted on its Department of Revenue website that individuals who lived out of Massachusetts but commuted in, usually for work, that were no longer doing so, must still continue to have their wage income sourced in Massachusetts. It was incredibly problematic to New Hampshire, which does not tax wage income. And New Hampshire now is challenging Massachusetts before the Supreme Court. That's the form of choice of when there are disputes between various states on its convenience rule. It's not a rule that's actually in statute in Massachusetts. New Jersey has taken note of this, and New Jersey has jumped on the bandwagon with New Hampshire. And I think Governor Murphy has also made some mentions of this in the press as well to push back. And if this is in fact overruled, I think that would really go a long way for New Jersey residents who typically work in New York as well.
One thing to clarify, a question came through. If a company now has an office in, let's just say, New York, hires 2 remote employees in another state that are really permanently working remote or doing online support in the services practice, company gets their payroll ID. Someone has a question to confirm whether they really need to register to do business in that state as well, not just having a employer ID. Once you have an employee physically in that state, would require a registration by the company.
Yeah, so payroll registration is for payroll taxes. So that's one thing. But you do need to register with the state to do business, because that relates to service of process, it relates to bankruptcy, it relates to tort liability. And if you have not registered in the state for that, a lot of times you won't have standing if there's a class action or there's some sort of action brought against you in a court. So it'll be a default judgment against you. So it is always a good idea to register. There's usually some minor costs involved with that to register, but it's something that certainly should be considered.
Alan, can you mute and then unmute again, because you got getting a little bit cut off. Just want to see if it's.
Hey, I muted and unmuted.
You still
hear me?
No, a little bit. It's a little bit.
Can you hear me?
We can hear you, but it's a little bit broken up. We can answer them. If not, we'll answer them in the chat. The PTE rates that you outlined before on the New York regime, do they have the same phase out as the individual regime does on the $50,000 change, the cliff vesting that you talked about under the new New York State tax rates? Now you mute.
How many times have you heard that now? So yeah, it's our understanding that it's a flat rate on that income right now. So there's not really that graduated rate. If your receipts fall within those categories, it's that flat rate that's being applied.
So those rates, just to confirm if those haven't heard, it would be the similar rates that our understanding at this point in time. One thing to remember that I didn't say it in my housekeeping intro is that these rules are evolving as the day goes on, and those inside the Anchin email string, get emails from Alan every morning as to another state updating their rules. So anything mentioned here today, or when we send the slides around, you'll notice it's effective as of 5/24. I'll give Alan the benefit of not looking at anything on 5/25. A question came up with regards to cost of performance and New York City. And I know we touched a little bit on cost of performance, but from a service company standpoint, cost of performance outside of New York City, you can comment if there's been any change on the way. Maybe you could talk a little bit how New York City views cost of performance for pass-through entities, and has there been anything that you have seen in any kind of regulation for New York City to change that, because that is a big corporate level tax.
Yeah, so that received a lot of play very early on in the pandemic, and so many people no longer commuted into New York City. And what happens is that pass-through entities operating in New York City are subject to the unincorporated business tax, 4% tax, and it is for service companies is based upon, as Mike said, cost of performance, where that business is operating, where do you have those employees generating their income. And if in fact they're in New York City, those receipts are then taxed under the UBT. So there was a lot of debate as to what New York City would do with so many people no longer commuting to New York City. Is there anything that they can do? Or would they try to still collect tax even though so many people were working outside of the city due to the pandemic? And to date, New York City has not done anything, and they've not issued anything. I think that's a great thing. Thankfully, businesses are now looking at where their employees were located and sourcing revenue that they've earned out of New York City, really reducing their UBT exposure. And quite frankly, I think that the law is pretty clear when it comes to cost of performance. And so I don't think that there's really much New York City can do in terms of changing it. Certainly not at this point. So many businesses have filed extensions.
So if a company moved their employees out to New Jersey, say, or they're working from home in New Jersey, and they still maintain an office in New York City, for the New York City UBT or the S corporation rules, those would be considered outside of New York City. Now, New Jersey and some other states during the course of the pandemic said that if employees are working from home during the pandemic, it would not create nexus. New Jersey was one of those states in that state. That's all the presence you have in that state. What we haven't heard anything yet, and you can tell me if there is when these states are going to say the pandemic is over. Hopefully that happens soon. But will they adjust their rules to say, okay, now if you have employees working from home, i.e. New Jersey, it's no longer a convenience because of the pandemic?
Yeah, so what many states did, as I said, is issue a temporary hold on Nexus due to the emergency orders that were in place. New Jersey being a great example of that. Many of the state rules and guidance that was issued either gave a firm date. A lot of those were the end of June, or sometimes it would be 90 days after the state of emergencies subsided. I think with the vaccine pretty readily available, schools maybe going back in September. I think those dates are going to be quickly approaching, and we're going to start seeing a lot of motion on that. And Mike, you're right. I think we're also going to start seeing updated rules. Remote work is here to stay. And how does that work? And how does that play out? And how does the convenience rule fit in? How do bona fide offices, fit into that? What potential nexus exposure? Mike, we talk to businesses all the time that have employees all over the country now, which they never had previously. So it's yet to be determined, but I think states realize that there's dollars at stake, for this. So we're going to see a lot of action in this area.
I think I've addressed many of the questions that have come through. If anyone has questions, I think Alan had the slide up ways to contact us. We'd be happy to answer any questions. Anything that we haven't gone to, we will revisit, and as well as we will send out the audio and the video. Maybe we'll try to clean up the audio in that last part. I think Alan's Wi-Fi went out a little bit on us. But I want to thank everybody for attending today. Again, please address any questions to us. We'd be happy to respond to them. Thank you.